Welcome to SmithWeekly Discussions, an occasional program for our readers and listeners of SmithWeekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. We remind our audience to examine our show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion, we want to say thanks for questions coming from our audience at SmithWeekly, including Cindy W., at U Belgium Bull, and at Might Have a Clue. Scott Melbye is on the show today. Scott is CEO, President, and Director of Uranium Royalty Corp, a uranium-focused royalty stream lending company with a portfolio of various staged uranium project royalties. The company also has an equity interest in London-based Yellowcake plc, a physical uranium investment vehicle. Uranium Royalty is listed on the Toronto Venture Exchange under the symbol URC and also on the US OTC markets under the symbol URCCF. Scott, thanks for coming on the show.
Andrew, it's great to be on, and I know we're overdue. We first talked about this when we met down in Adelaide at the Australian Uranium Conference, and so it's a real pleasure to be with your listeners and readers today.
Yeah, it's been a while and good to have you on, good to chat. Well, Scott, let's go back for a moment before we get into current events. You've had a long history in the uranium business. Can you give the audience your background, where you've been, some key industry people that you've established relationships with along the way?
Well, sure. It's unusual now to look back on my career, which has been 35 years in nuclear energy and uranium mining, brokerage, trading, every aspect of the fuel cycle. But it's really been valuable to have lived through all the challenges and opportunities and ups and downs that the uranium market has experienced over that time. My career began in the early days as a broker and trader with Nuchem out of New York, a fuel buyer with a utility company with Arizona Public Service at the Palo Verde Nuclear Station in Arizona, which gave some really good perspective on the buying side of the business. But most of my career has been focused on uranium mining side. And I've had the fortunate opportunity to be with three of the four largest uranium mining companies in the world in leadership positions in marketing and sales. 23 years of that with Cameco, including president of their global marketing subsidiary, Cameco Inc., which brought me all over the world and contracting with essentially every nuclear utility around the globe. Had an interesting experience with Uranium One, with the mines in the United States and Kazakhstan, and working closely in the United Arab Emirates and markets into China. And then more recently served as an advisor to the CEO of Kazatomprom as part of their transformation activities as they were preparing for their IPO. But over the last 5-6 years now, it's been with Uranium Energy Corp as an executive with U.S. ISR company based out of Corpus Christi, and also had some involvement with UPC, the Denison managed uranium commodity fund and managing uranium activities for them. So certainly have seen every angle and every aspect of the uranium industry over these years, but it's really it's an exciting industry that I don't think I would want to have devoted my time to any other industry. It's really it's been an amazing experience.
Scott, where are we in the uranium market now? We've got broad market forces that seem to be prevailing first, but then we have positive production suspensions coming out of nearly all remaining production centers around the world. Where are we headed? And will the broad market action govern the response in the uranium sector?
Yeah, well, I mean, listen, to your readers and listeners, we're all aware that uranium has probably gone through the toughest, longest bear market of any commodity. Really, you could look at it as a 9-year bear market following the activities of the events of Fukushima. But I think it's more important to think that, really, the rebalancing and the positive fundamental shift that we've seen in uranium really only occurred in earnest in 2017, because up to that point, we saw uranium production increasing year over year, even in the face of falling uranium prices. And that's kind of due to the inefficient nature of the uranium market. It takes a long time to bring uranium mines into production, but it also, we see a lagging effect to take production offline when prices are falling because of the hedged nature of our industry, very different than, say, copper or gold, where you have real-time impacts on supply and demand from price signals. So it really wasn't until 2017 when contracts started to roll off in these portfolios and producers began to cut back production dramatically. It's also interesting to note, too, that in the early stage of this bear market, we were really seeing big impacts to the demand side with the shutdowns in Japan, the slow restarts, the slow phase out of German reactors, and reactor construction around the world. But now as we sit today, on the demand side, we're back to the pre-Fukushima levels of nuclear generation and uranium requirements. The world needs between 180 and 190 million pounds of uranium annually. That's going to 200 million in the coming years. So, the demand side is robust and strong. The supply side is what really needed to adjust, and producers have really stepped up and cut production to the tune of 40 to 50 million pounds over this period annually, over what we were just seeing a few years ago. That condition has also been made even more interesting by the COVID-19 impacts on a number of production centers around the world, the biggest, most recent impact being the decision by Cameco and Orano to cut back shut-in production at Cigar Lake. So you have Canada effectively producing no uranium today. You have Namibia shutting in all their mines, Husab and other production, Rossing in Namibia. But this is really having an accelerated effect on this rebalancing. We knew the world's uranium industry was producing too much uranium. It was being incentivized by old legacy contracts. As those have fallen off, it was incumbent on production to cut back. That's been happening now in earnest since 2017 at that rate of 40, 50 million pounds a year. Now it's increasing even greater due to the coronavirus impact. So we have really good reason to be optimistic about where we're at in the uranium cycle today. I think the last catalyst to hit was the uranium procurement. Just as those contracts were rolling off for producers, utilities were also falling out of their contract coverage. However, instead of jumping back into the 10-year contracts they just got out of, they really were quite content to play the spot market, play the carry trade market, where they're able to lower their fuel costs by really taking advantage of cheap supplies in the near term. Now we realize that strategically, when the winds shift, they've got to adjust the sails, and I think we're beginning to see that now. We saw utility procurement pick up in the fourth quarter at the end of the year, and we're continuing to see it now. And I think with some of these supply threats that we've seen, whether it's COVID-19 or it's threats to say supplies from Iran sanctions waivers impacting Russian supplies, I think utilities are beginning to realize now that price is not the only determining factor in putting their supply portfolio together. It might make sense to be diversified. It might make sense to have, as North American utilities, have more North American supply and just balance their portfolios better. So we really have great reason to be optimistic going into 2020, and we're beginning to see that now in the uranium price, which in the midst of everything going on in the global financial markets, we've seen uranium go from $24 a pound to close to $27.50, $28 a pound today. So it's really performed quite well considering everything that's going on around the world.
Yes, and I would just say this recent chain of events across the globe have taken the just-in-time inventory model and completely thrown it out the window. And if the utilities think that just-in-time inventory is going to work for them, they're soon going to find out that that's not going to work out as well as they intended. I want to ask you, Scott, how do the uranium equities, how are these going to respond in the event the broad market continues to be the focus? Even though we have positive factors that are occurring in the uranium market, which you could argue that have been occurring for years at this point, do you see that these suspensions will cause uranium to continue to do well and also resulting in the equities doing well, while the broad market potentially continues to fall, how do you see the equities coming out of this over this volatile period?
Let's face it, whether it's retail investors or it's institutional investors, there was a lot of fatigue from these investors in the uranium market, where the recovery has been so slow and it's taken so long. So I think to some degree, and I know this is true for the institutional investors, they love the space. They love the fundamentals. Their economists tell them that, hey, uranium is probably one of the best positioned commodities in the world today, but they can't afford to be early, and they've even made forays in and been too early and backed out. So I think there's a real sense of show me from the institutions. I think they need to see real legs under the market, and I think for them, seeing real movements and sustainable movements in the spot price will cause them to come back in, and they'll come back in a very big way. And your readers all realize that there's not a huge number of investments that capital can pour into in the uranium industry. All that capital really goes through a limited number of doors. And so you see the trading volumes in these periods go off the charts. I think we're on the verge of that now, where I think, even if coronavirus impacts on production are temporary, I think the rebalancing, even if it helps draw down inventories for a period of 2-3 months, that's very positive in terms of accelerating this point to where, the inventories are drawn down and we need new mine production. And that's where it gets interesting, because even with the existing restart mine production, which we believe Cameco will come back at some point, Husab will come back, Rossing will come back, but over and above that, we need new mine production, and we're very rapidly getting into the point where we're in the lead times required to bring on new mines. Uranium it's very difficult to permit any mine in the world today. Add the complexities of a uranium mine, and you're looking at 6, 7, 8 to 10 years to permit, license, and construct a new mine today. So if we need new mine production in, say, 2025, there's very limited number of projects in the world today that can respond to that. So I kind of look at it, and I guess I would look at it as an investor looking at the equities. I would also look at it the same way as the CEO of Uranium Royalty Corp. I kind of put companies in two categories in the nearer term. There are companies that can produce and cash flow in this coming cycle. And by that, I mean this cycle that we're in now in 2020 that's taking off. And let's face it, that's going to be very limited to the mines that are in temporary standby and have restart potential, or mines that are fully permitted, licensed, and the decision to go forward is theirs, and they have the capital backing to do it. That's limited, but there is a group of companies that fit that category. There's another category of uranium companies that may not be producing and cash flowing immediately in this cycle, but their projects are going to really see the ball advance dramatically in a bull market cycle. And so I think as investors, it doesn't mean that you don't take a longer term view on exploration plays or things that are kind of down the road, because their value will be unlocked as the bull market unfolds. But right. I think if you really want the biggest pop, you're looking at the companies that can respond quickly. That usually means permitted, licensed, or built and standby operations, or those that will really, really advance their corporate plans in the next cycle.
If the broad market continues to be volatile with fear and there's a need for liquidity, I still see that there could be some potential selling, even in light of the continuing, improving, fantastic fundamentals that we have in this sector. But we'll see. Time will tell. Scott, let's change over here for a moment. Can you just speak to your relationships with people in the sector? Who do you pay attention to, and why are they important to you?
Well, I think, one of the benefits of being in the industry all these years, and I think really valuing relationships, whether it's on the utility side or the producer side, is the ability to really draw from various corners of the industry. It's nice to be able to have relationships with the Chinese utilities or U.S. nuclear fuel buyers, or those in Europe or elsewhere. And so it's always important to to gauge, where they're thinking. At the end of the day, they're the customers, they're the ultimate buyers. So I pay a great deal of attention to what they're doing and what trends I'm seeing there. Just a lifetime of experiences with, having worked with the Russians at Rosatom and Uranium One, and the great, enormous growth that they're experiencing in reactor construction around the world, or in Kazakhstan, where they lead production today. It's really invaluable to have those kind of relationships. Certainly, the folks at Cameco are going through very difficult, challenging times, but making really, big strategic decisions right now. It's just important to stay plugged into all of them, and always be humble enough to realize that you don't always have all the answers, and it's good to have a network of folks that you're drawing on for information and views.
Well, very well. Scott, I got just two more questions before we get into Uranium Royalty Corp. Just looking back over this bear market, what do you think has been the biggest problem for the sector, Scott? Is it really the prolonged low uranium price environment, or was the bigger issue at hand maybe potentially misdirection and mishandling by management teams that had also contributed to the damage equal to or more than the low price environment? What do you see there as really the big driver? I mean, we obviously know that Fukushima was part of that, but then oversupply was coming into that before Fukushima. Do you see that management potentially has gotten smarter this next cycle?
Yeah, I mean, it's hard to blame the market. It's an inanimate object, and the market is the market. And events, life is life. You have Fukushimas, you have COVID-19, things happen. So you can't really blame that, but you do have to look at how companies react to markets and decisions that are made. And I don't want to be too hard on producers either. I mean, obviously, from 2011 to 2016, uranium was consistently falling from $70 a pound down to $17 a pound, yet production increased year over year. Now, again, I think the reasons for that are this inefficient nature of the uranium market, where, producers did have baseload contracts, legacy contracts that they could produce into for a profit. So, it's hard to blame them for, producing and getting into production at that time. Now, I think this inefficient nature of the uranium market works to the investors' benefit going forward, because in an undersupplied market, the supplies are not that readily available to respond to higher prices. So, again, I think the easy answer is we were producing too much uranium and causing an oversupplied market. And it really wasn't until 2017 that started to be corrected in a big way, and now we're seeing that rebalancing really accelerate. So I think that's really the crux of it, because the demand is fine. I mean, we're seeing pre-Fukushima levels of nuclear generation. The reactor construction is robust around the world. We're now beginning to see SMR reactors, which will be ideal additions to the demand side in markets where they've got to compete with a heavy renewable-dominated markets. They can be more load-following, and that may be with cheap gas like we have in the United States. So I think, really the supply side is what needed to be adjusted, and we're now seeing that happen in a big way.
Yes. Thoughts on the conversion and enrichment markets, and then also your thoughts on this nuclear fuel working group outcome?
Yeah, we obviously, as uranium producers, we focus so much on the uranium side and uranium mine development, but conversion has always been, it's the least costly element, component of the fuel cycle. Yet everything flows through, these three, major conversion facilities around the world, and what happens there has a big impact. Enrichment has been an oversupply, really driven enrichment prices from over $100 a SWU down to, $30, $40 a SWU. That has impact too. That's caused underfeeding, and that's, the underfeeding of enrichers around the world has been the equivalent of an enormous MacArthur or Cigar Lake sized mine. Good news is that's probably the peak contribution from that source of supply, and we'll begin to see less going forward rather than more. but uranium investors do need to fully understand the impacts of the other segments of the fuel cycle, because they do have an impact on what's happening right now. I mean, even if you lost a major fabrication plant or enrichment plant or conversion plant due to coronavirus issues, that may mean that alternate supplies need to be sourced, and EUP and fuel assemblies need to be put together on short notice. Well, that can cause completely unpredictable demand on the uranium market. So it's always wise to look at the other elements of the fuel cycle. Nuclear Fuel Working Group, it's unfortunate because the president, following the decision not to move forward with tariffs or quotas as part of the 232 investigation, instituted this task force of cabinet level officials and agencies to really look at ways to revitalize the uranium industry. And I've always been of the opinion that this working group has the potential to have a more lasting impact on the industry going forward than, say, even, a tariff or quota might have a more immediate impact on the industry, but I think a more lasting solution can come out of these working group conclusions and policies. Unfortunately, as we sit today, the working group policy recommendations sit on Larry Kudlow's desk today, and understandably, there's other priorities in the White House that are going to take priority. Anything related to coronavirus, that's job one right now. Now, while that may have pushed off the release of the working group recommendations, another story has kind of emerged, and it's really been highlighted by the coronavirus, is that, it highlights our over-reliance on foreign countries, some of them not necessarily even good friends of ours, for strategic things. Like in coronavirus, we've seen pharmaceuticals, masks, gloves, things like this. But we've also seen during this time the sort of the oil price war between the Saudis and the Russians impact our oil and gas industry in the United States. We've seen the Chinese essentially take over the rare earth metals and critical minerals supplies for the United States, and we've seen, obviously, state-owned companies in the uranium industry really impact a vital and healthy uranium industry. I think the potential for all of these to be wrapped together and dealt with by the administration is very high right now. I know oil and gas didn't get dealt with in the last stimulus bill that passed, but we do know that these are high priorities, and evidenced by Secretary Pompeo at the State Department in a speech last week, not only highlighted the oil and gas vulnerabilities and critical minerals, but named uranium and the nuclear fuel cycle specifically as something that's vulnerable and needs to be corrected. So I think we have to be patient. The president has a lot of priorities. The first is just really addressing the medical issues around coronavirus. But I think very shortly and forthcoming will be policies that really advance the ball. Listen, the $150 million uranium reserve is a good start. If it's a 10-year program and it can be administered in a way that gives a kickstart to revitalize the domestic production, that's great. But I think there's other things. The Secretary of Energy has promised that the policies will be more than just that. So I think we just have to be patient and realize that the administration prioritizes this. It's just going to take more time.
Yes, I did respond to the RFI request from the Department of Energy Office of Nuclear, and we expressed that in our letter that there's a bigger problem at hand. It's not the small uranium sector. It's a much larger problem, and it has to do with strategic policy to be a leader in nuclear power, not just in the United States, but globally, to compete with the Russians, to compete with the Chinese, to compete with people who are going around and selling turnkey packages to other countries to deploy nuclear energy. The U.S. needs to lead in that, and that's what we expressed in our letter. And as a result of significant programs and strategic policies put in place to enact that strategy of gaining market share in the global nuclear power sector, that will indirectly lead down the complete supply chain of more uranium, more conversion, more enrichment, a healthy environment for the entire industry. So we expressed that pretty hard in our letter in response to their RFI, which of course their RFI was focused just on small domestic stuff, but they didn't understand that there's a bigger problem at stake. We brought that forward. Whether or not they'll do anything, I don't know. But if they're willing to spend, if you include the Fed, $5-6 trillion in stimulus, which is really what it is, even though they say it's two, for COVID-19, you would expect that spending $500 billion to get into nuclear power global market to compete with the Russians and the Chinese, Scott, that would indirectly come back and support a domestic economy for nuclear like no other could, in my opinion. So we made that clear in our letter, but they'll probably just laugh at us and wonder what thing we're smoking and what planet we're living on. But
no, you make really good points, and that is so true. It's not only about American energy security. I mean, 20% of our electricity is from nuclear, and having almost a complete reliance on foreign supplies, many of it from state-owned entities. That's not good policy. We didn't find it acceptable back when we were losing control over oil and gas supplies back in the day. But it's also about American leadership in a geopolitical sense around the world. I mean, as you mentioned, China, Russia use nuclear energy and turnkey projects all over the world as a way to really entrench themselves in South America, Africa, Europe, the Middle East. And so, the U.S. has to decide whether we want to lead or be left behind.
And from the 40s, probably arguably through the 90s, the U.S. was the global nuclear leader. Where did Japan get their capabilities? Where did Japan get their big fleet of nuclear reactors? Well, it was led by the U.S. But certainly they've got some bigger issues at hand that would certainly fix some of these smaller issues that have been brought up. But I don't know that they have the stomach to step out with that type of aggression and ambition to regain that market share. But we'll see what happens.
They're saying the right things, but let's see if they execute. But we're optimistic.
Yes, absolutely. Okay, let's talk about uranium royalty. First off, I want to just talk more about the assets and so forth in a moment, Scott. But first, can you start us off looking at the capital structure, the cash on hand, and the key backers on the share roster?
Yes, the company has been around for 3 years now. It was founded by kind of the key foundational shareholders, folks like Marin Katusa, Rick Rule, Amir Adnani, and myself, Warren Gilman, Darren Millmeister of Extract Capital. I think back 3 years ago and before that, we kind of looked at the incredible success that royalty and streaming companies had in base and precious metals. And these are companies like Franco-Nevada, Royal Gold, Wheaton Precious, Sandstorm. They've emerged into a $40 billion industry, and they've become a very popular way for investors to have diversified exposure into these commodities. But they've also provided a very valuable form of alternative finance to support mine development in these industries. So we founded the company, took it public in December of last year, where we raised $30 million on an oversubscribed IPO on the TSX. It's amazing, but we were the largest mining IPO in Canada last year, perhaps maybe in the last 2 or 3 years. But it really got a strong reception. Our timing was obviously good. We couldn't foresee what was happening in global financial markets. But as we sit today, we're in a very good position with $40 million in cash and marketable securities that really put us in a great position to grow the company. And we've launched with a portfolio that we're quite proud of, and it's a very respectable portfolio. But the real focus of this company, it's a growth company, and that's what we've seen. And we've taken the best practices and from these companies and other commodities and applied it to uranium royalties. So where we're really going to we're going to see growth and building on that portfolio every year. This company is going to get bigger and bigger and have a more broader, diversified portfolio. So as we sit today, we're very well funded. The intention and certainly the pipeline for potential royalties and streams is great. You can only imagine how difficult it is for uranium producers today to know that their production is needed in the coming years, but the capital markets and uranium markets just haven't been incentivizing that investment. So, you're really faced with, do you advance your project through debt, which may not even be an option, or equity, which results in further dilution of existing shareholders. So you look at royalties and streams as perhaps one of the best financing alternatives for uranium mine developers in the market today. So we have a very robust pipeline in front of us. I will say that we aggressively want to grow the company. We don't want to just do deals though, just for the sake of putting deals up on the scoreboard. We want to do accretive deals, smart deals. We want to do our homework on due diligence on geology, mining engineering, management, resources, and finances to ensure that out of the universe of companies that are out there that have the potential to fill this gap in the coming years, we're aligning our capital with the ones that we think have the most promise. The whole financial market turmoil has caused us to be more cautious than I thought we would be going into the year, because we really, as a capital provider, we have to ask the question, what is the true cost of capital today for a uranium mine developer? Has it changed dramatically? Is it fundamentally changed going forward, or are we in a temporary situation? But that is causing us to be a little more careful, under normal ideal situation until we get to be self-sustaining by our own cash flows. The model is go out, acquire royalties and streams, and raise capital to fund this growth in these early years. Well, once we deplete and deploy our cash position today, we're going to have to go back to these same difficult markets. So, we're being a little more cautious than I thought we would be going into the year, but I can tell you our due diligence teams and technical teams couldn't be more busy pursuing opportunities and looking at projects around the world. So we have 72 million shares outstanding, plus the 27.9 million warrants that were part of the IPO offering. The IPO was priced at $1.50 per unit, which gave you a common share and a full warrant, 5-year expiration at $2 a share. When we launched that, the market kind of priced those two components at $1.25 for the share and 25 cents for the warrant. The proceeds from that, $30 million, that went to close conditional royalties that we had on an optional basis that were to close on IPO. It also allowed us to pay down the bridge financing that allowed us to acquire foundational shareholding in Yellowcake when they went public on the London Exchange. So it leaves us today with $40 million in cash and cash equivalents or marketable securities and no debt. 72 million shares. It's a market cap today of around $65 million. Again, it puts us in a really strong balance sheet position. So we're, really looking at, where are the absolute best counterparties that we can put into the portfolio with an eye to near-term, cash flowing assets. And I realize in the uranium market, it's not a universe like you see in copper or gold where, there are opportunities to do a stream with a copper producer who's going to be in production, 18, 24 months from now, and it's pretty certain, and there's not a lot of uncertainty that isn't going to come into production. Uranium's different, and nobody understands the risks and the opportunities of uranium more than we do. We realize the permitting risks and production risks, market risks. But as I said earlier, we're putting a priority right now on our corporate development activities on those projects that can be producing and cash flowing in the next cycle, or really see their company advance their business plans dramatically in this next cycle. So that's the focus, and it's going to be an exciting year.
And Scott, can you speak just briefly about the key people at the company? Who do you want to highlight?
One of the attractions of a royalty and streaming company, if you look at our role models in base and precious metals, these are some of the most profitable companies per headcount of any industries in the world today. The reason being is we don't own the mines. We don't operate the mines. We have financial interests, either financial through royalties or physical through streams of physical commodity from these projects. And so these are typically companies with very low G&A and very small headcount. So we're no exception to that. But the people that we have assembled are really quality people that understand capital markets and uranium businesses as well as anyone. The board of directors today, in addition to myself, we have Amir Adnani, who serves as chairman, obviously brings his entrepreneurial energy to it, but he pretty much leaves the day-to-day to the management team, but really provides valuable guidance and counsel. Lady Barbara Judge is someone, it's incredible to have her. She was the first female board member of the U.S. Securities and Exchange Commission as a commissioner. She serves on the advisory boards of Emirates Nuclear Energy, Tokyo Electric Power. She helped found the Astana Stock Exchange in Kazakhstan, and was a chair and board member of the UK Atomic Energy Commission. So she gets the big picture in nuclear energy and has a world of relationships and perspectives to add. Dave Neuberger is someone that I was really excited to bring to the company in a board role. Dave was VP of mining for Cameco. He was there through all the construction and operation of the world's richest, highest grade mines in Saskatchewan and Cameco's global activities. He's a wonderful sounding board from a mining, engineering, and operational perspective when we're looking at investing in various companies. And then Veena Patel, who is just a real pro in terms of capital markets in Europe and around the world. So that's our board of directors. On the management team, it's a very small group where we have myself bringing all my years of experience. Darcy Hurstcorn is a 20-year veteran of Cameco Global Exploration and is our chief technical officer that leads the due diligence, which is so important in what we do and in fully understanding these projects, the resource base, and the ability to mine from them. And then on the finance corporate development side, Josephine Mann is our CFO out of Vancouver, and Bruce Nicholson, who provides incredible support in terms of financial modeling and making sure we're putting the right value when we make an offer on a royalty or stream, that we're valuing that properly from a financial perspective. So that's a very small team, but it's a very talented team. In terms of G&A, this is a company that, shouldn't require, we could double, triple in size and not really have to grow that much dramatically from where we are today. In the prospectus, I think we targeted annual G&A of about 1.4 million Canadian per year. Given the difficult conditions in the markets, we've cut that back to $1 million a year, not a month, a year, to fund this company. And we're even, obviously, like most companies, looking at ways to even reduce that even further. But anyway, it's a very lean company, and we intend to keep it that way.
And Scott, can you speak to where you own your shares as far as cost basis, and how does management plan to align themselves with that of the shareholders who bought into the IPO and going forward?
Sure. Well, I mean, if you look at the insider ownership, the foundational ownership, you have kind of the big corporate ownership, which is, the UEC Mega Altius, which vended in royalties and share in exchange for shares. Guys like Marin Cadusa, Rick Rule, who are, in this for the long haul. Amir, I think, was one of the largest individual checks written in the IPO. So, we have a lot of skin in the game here, and I would say to date, all the shares that we own are shares that we purchased. I have about 475,000 shares. I've been acquired, obviously, on the foundation, wrote one of the first checks, but I've bought at each stage, including the IPO, to really increase my stake. In terms of incentive compensation, that's something obviously we want to, our management team is taking very minimal salaries to get this thing off the ground because we believe in it and we see the growth and we want to see our investments be successful. We will put in place an incentive plan for the board and management that aligns them to the shareholders. But I think our view is first things first. Let's get off the ground. Let's get some initial deals in place. Let's get some cash flow established, and then let's focus on compensation issues. And I know that's not a very common view amongst public companies today, but it's something we're doing. We believe in the company, the concept, and we're vested through our own personal investments. And we will follow on with those sort of incentive plans once we kind of get up and get our feet on the ground.
Okay. And would you say that you guys have a cost basis that's around the current share price, above or below? Can you speak to that?
I wouldn't be able to tell you what that average is, but like I said, when we founded the company, back in 2017, we wrote the initial checks literally just to get the company off the ground and raised, under $3 million back in 2017, really just to get a CEO hired, get letterhead and get going. The dollar round was a big funding round where about 15 million shares were issued at that time at $1. A lot of the insiders and foundational shareholders were in on that. And then on the $1.50 round, I can say as well that a lot of us were in on that round. So we kind of represent the whole spectrum of where we're at, but I think you have very patient hands too, in that, in these insider or foundational shareholders, there's either explicit hold periods or voluntary hold periods, but that could be, 50% or more of the company is held by very long-term oriented shareholders. So that should give comfort that, we're in it for the long haul. And again, I think it's totally reasonable to view this as being a billion-dollar company. If we follow the same growth trajectory as these other companies in base and precious metals have taken, and we execute on the growth plans that we have in place, and we see that it is possible, this is going to be a very big company in the coming years. How quickly that happens is how well we execute on the plan.
Well, Scott, let's move on. Let's talk about just highlight for us, and I want to get into a couple of them. Can you talk a little bit about the key royalty assets that you guys have, and of course, any equity interests that you want to mention?
Sure. So the biggest holding we have is the holding that we have in Yellowcake PLC out of London. Maybe some explanation of why physical, which I think is a reasonable question. I think it's safe to say we're never going to be too much physical in terms of our investments, but we found that, given the stage in the uranium cycle that we're in and where uranium prices have been, an investment in physical, our 7.6 million shares of Yellowcake, just under 9% of that company that we bought in the initial offering of Yellowcake, effectively gave us ownership in $21 uranium. I can tell you, knowing what it takes to discover, produce, and sell a drum of Yellowcake, to be able to buy it at, effectively in the holdings of Yellowcake at $20 a pound is a great investment. And that also gives exposure to our early shareholders, that they'll get the capital appreciation. We've already seen that a Yellowcake, I think, has been up about 18% over the last week or so, but they'll realize the capital appreciation, the value of that investment in these early years before we start getting steady state cash flowing royalties and streams coming in. So that's kind of the reason, but it also presented some strategic cooperation with Yellowcake in terms of royalties and streams that they may come aware of, or ability to participate with them on those. And also it allows us to purchase up to $31 million US of uranium from Kazatomprom under their $1 billion supply agreement. So it's a very strategic investment. It's one that we're quite pleased to be in, and to date is our largest single shareholding. Then in terms of the existing portfolio, you can kind of put it in various buckets. We have the US ISR assets that We have holdings in Reno Creek, Dewey Burdock, Lance, Church Rock. I mean, admittedly, these are very small holdings. Some of them came out of acquisitions. For example, Dewey Burdock, Lance, and Church Rock were part of an acquisition from Westwater, which was about $3 million investment, $2 million of which was a receivable, which was paid to us just earlier this year. So really the price of acquiring the Dewey Burdock, Lance, and Church Rock royalties was less than $1 million. So we love the projects. They're just very small. Reno Creek, it's a small net profit interest, but we believe Reno Creek, and like we believe generally, well-run ISR projects in the United States with good assets, good operations, good management can be some of the first early movers with or without U.S. government assistance. I mean, I think it's important to note that a well-run ISR mine can be in the lower half of cost quartile globally. So we want to be exposed there. I mean, I think on all of these, we love the projects. They're just very small interest to date. We have interest in U.S. conventional, which is admittedly, that's higher cost production, whose value will be crystallized in the coming bull market, but won't be some of the earliest fast movers, with the exception of perhaps some of the higher grade conventional deposits on the Colorado Plateau. I mean, they may be higher cost than ISR in the U.S., but they have huge strategic value, and I think as part of the whole revitalization of the U.S. uranium industry, we'll see, that Four Corners area of the U.S. be an area where there is growth. In Canada, in the Athabasca Basin, we were very pleased to acquire just under 2% net smelter return, NSR royalty on the Rough Rider project. Now, again, this is not something that's going to be producing in the coming cycle, but has enormous strategic value. This was a project that was the object of a bidding war between Rio Tinto and Cameco. Rio Tinto ultimately prevailing and in acquiring this for $600 million. It's a very interesting deal. We went not to Rio Tinto, but to the underlying royalty owners, 40 or 50 of these royalty owners, and individually going to them and acquiring their royalties, either offering them either cash or shares. And I think it came out to about half cash, half shares to acquire this just under 2% NSR interest in Rough Rider. So a little bit longer term, but huge value, a lot of pounds in the right part of the world. I think as this generation of current mines in Saskatchewan depletes, Rough Rider is going to be one of the first movers as well. Langer Heinrich is an interesting one for us. We think it can be an early mover. It's a fixed royalty per kilogram or per pound. But what we like about Langer is it's a restart project, and they've gone through a very extensive cost and efficiency exercise to reduce the production cost in a restart. They have a couple of restart scenarios that they believe they can be very competitive in a $40 to $50 market, which we think is very reasonable to assume in the coming years. We like Langer. It's been a proven producer. It's produced several million pounds, per year for a number of years. We think the restart there is quite attractive. Michelin is something which is a longer-term play. It's a 2% GRR on Michelin, which in the last cycle was a very significant deposit, which is owned by EDF interests and the Chinese. But again, was an all-share deal with Altius, who were quite intent to take shares in URC, given that they're in the broader royalty business. They like the model, and they're quite content to have an investment in URC. So again, I think we're quite, we're proud of the inaugural portfolio, but obviously you can go into and put your own values on these and make your own assumptions in terms of when they'll produce and cash flow. But I think the real value, we're going to build on this portfolio, and I would say the portfolio, every year, we'll just continue to grow. And it's really the projects that we're looking to add that will have perhaps add to the near-term cash flow potential that will really be exciting in the coming months.
And Scott, I want to go back to Rough Rider for just a moment. The NSR that you guys have there, Can you just share a little bit more with us about what you guys see as a net asset value for that asset? When do you see it come into production? Do you see it happening this decade?
We don't on the project side, we don't get into granular detail on what we value those. It's kind of it's part of our competitive position. But what I would encourage everyone to do is take the information that's in the public domain to kind of put your own assumptions on that. I will say that we tend to use a $50 uranium price would be a reasonable, and some might say, well, that's higher than today's spot, but there won't be a viable uranium industry if prices aren't in the $40 to $50 a pound, or frankly higher than that. So we kind of use that valuation. We would plug in assumptions in terms of development times. I will tell you, we're quite conservative and how we see this coming on. I think that would be true with all of our assumptions on projects. And I know sometimes it's a challenging position that we're in, because when we're in a negotiation on a new royalty and stream with a counterparty, every management team loves their baby. It's the most beautiful baby that was ever born, and we may think it's a beautiful baby too, but we may actually say, okay, we have people on we have 3 former Cameco employees on our management and board that went through a 10-year development timeline from McArthur River. We've gone through the technical challenges of mining in the basin. And so, I will say that we tend to be pretty conservative when we lay out, capital and invest in a project. So I think with each one of these, I think it's fair to put your own layer on your own assumptions of how quickly that can come on. But I can tell you, we're probably more conservative than most, just because we've been there and we've gone through development of mines and know what it takes.
Yes, and I want to ask you a little bit more about which asset that you see will be first cash flow for the company, Scott, maybe such as a restart asset. What do you see there as potentials to be kind of first off the ground? And then also, It's going to be tough to determine at this point, but do you see that happening sometime in the next 2 to 3 years? I mean, when do you see the company will actually start to see some cash flow come in?
Yeah, so obviously not cash flow, but Yellowcake will have the most immediate. We're seeing benefits occurring as we speak. We did get a $2 million payment cash flow in from the Westwater portfolio earlier this year. So there is some cash and early benefits before we get to a steady state. But I think you have to look at US ISR in the portfolio probably is I would consider near term and this cycle type projects. And Langer Heinrich, I think we're quite optimistic that with recovery in prices, we see that going back in production. And again, I would say that a number of the projects that we're looking at in the pipeline today can be, the earliest, if not the earliest, cash flowing, depending on, I can't predict the success of the various discussions that we're in, or those in the pipeline that we intend to go after this year. But a number of those, could be providing cash flow as early as this year, next year, certainly, in the next year to 3 years. And remember, our G&A burn for a company this size, it may only be a deal or two, in this market that allows us to cover our G&A and then be able to move forward, go forward from there, where everything built on top of that we begin to get ahead of the game. So again, I know it's difficult in uranium. We don't want a lot of new mines incentivized too early, but we do really recognize that, in the coming 5 years, new mines need to come on, and there aren't a lot of incentives for those mines to come on. So we're kind of playing that fine line, but we recognize that investors want visibility to near-term cash flowing assets. So stay tuned. We're obviously focused on that in our corporate development activities in 2020.
Okay. And Scott, when do you see, as far as your guys' current cash situation, let's say you don't have a steady state flow until, let's say, 2 years from now, Do you guys have sufficient capital at this point to not do any further equity financings to sustain both deals, G&A, and also enough cash runway to last out another 2 years before you potentially see some kind of cash flow steady state coming in?
Yeah, well, I mean that's the advantage of being a royalty and streaming company over being a minor developer is we just don't have the to have mines in standby or in development is a really big draw on resources. But at less than $1 million a year to fund the company, including regulatory requirements, minimal office space. We have a decentralized office structure and salaries, which are at, I would say, way below benchmark levels at this stage, understandably. With $40 million in cash and marketable securities today, we're in good shape. But again, we're the focus is on bringing in deals that begin to cover our G&A. Won't take a lot of deals at that rate to cover that. And the runway for a company our size, we're in an enviable position. I'll also say that as a lifelong uranium guy, I've been rooting for the uranium price to recover my whole career. And ideally would have liked to seen that yesterday by now. But in a royalty and streaming company, it's not the end of the world. If this drags out longer, although I don't think that's going to be the case anymore, just the more we're needed in a alternative financing provider, we become more attractive. The longer this market drags on, and so again, we want the uranium price to recover as quickly as everyone else. But even if it drags on longer, it's not the end of the world. Our cash burn is minimal, and puts us in a good position to do accretive deals.
And going forward, what types of deals will the company be looking to make, Scott? Does the focus remain on royalties, offtake, financings, streams, equity purchases? What are you looking to do here?
So it's really, those two sort of categories. The companies that can cash flow and stream in the next cycle, that's a restart or fully permitted licensed projects. We're quite content to take cash royalties from production or physical streams. We have an account at Cameco, so we can take physical uranium in. We can hold it. We can sell it forward. Receiving uranium and being able to create added value from that physical uranium is not something that's foreign to me, having been in my roles through the last 35 years. So we're quite content to do either. So, it's really either or royalties or streams, and looking at those projects who's really see the needle moving in this coming cycle. It doesn't mean that there isn't a market for longer term, call them tuck away royalties. I think every successful royalty company has those. You can have a tuck away royalty that you can acquire quite cheaply. You set it aside, tuck it away, and then 10 years from now, that can be, Rough Rider's a great example. It's not going to be cash flowing tomorrow, but there will be a point where that can be a very significant cash flow provider to the company going forward. But we realize the focus of investors now is they want to see near term projects, and that's where our attention is.
And Scott, what can investors expect as far as news coming during 2020? We're already a quarter in here. Does the company expect to have more deals announced this year?
Yeah, I mean, clearly, I think only by virtue of what's happened to financial markets, I would have expected that we would have deals to announce already this early in 2020. I think it has caused us to kind of go a little bit slower, more cautiously on some of these deals. But this is a growth vehicle. We're not launching on, the value of our existing portfolio and that's it. That's the end of the story. No, the story is the deals that we put into the portfolio going forward. So I can tell you our management team is very actively pursuing a number of opportunities and leads as we speak, and hope to have very good news over the course of the year, and that will be a regular. As you look at this company year over year, the portfolio will grow. I look at companies like Sandstorm or Royal Gold or Franco, and you look at the almost catalog of projects that they have, having been in business 10, 15 years. And it's exciting to think of, when we get to that stage where you've really got a diversified investment in various projects in Africa, Australia, North America, all around the world, ISR, conventional, various stages of development. I mean, that's the vision that we want to get to, and obviously want to get there as quickly as we can, but we want to do it smartly. I mean, we have to be we have to be disciplined in terms of those investments. It's great to be able to announce deals, but we want those deals to kind of stand the bright light of scrutiny and say, yeah, that's accretive, that's a good move.
Right. And do you think that right now, given where we are in this low level of the market, is there some motivation at management at this point to say, hey, we need to see if we can find a few more cheap deals before this market gets going? Is that also in the back of your mind?
Well, yeah. I mean, it's we have to determine what the true cost of capital is before we offer financing to developers. But we also recognize that this is a real fertile market for us to be operating in. We've seen some of the recent equity financings in the uranium space have resulted in very big discounts to the share price and dilution. We want to be able to provide an alternative to those developers and producers and say, hey, we're the best financing alternative for them, not that's better than debt or equity, and we have that ability right now. So we clearly are very focused on new deals and all things considered with the financial markets where they are today. But yeah, we're very, very focused on adding those deals while the getting's good.
And Scott, speak to the Yellow Cake investment for a moment. Is this a long-term holding for the company, or in the event that the company needs cash for deals, will it consider liquidation instead of equity financings to raise capital?
Yeah, I mean, it is a liquid asset, so it is available. I think we like the Yellow Cake investment. We like being able to own $20 uranium already now in a $27, $28 market. We own $20 uranium. That's a good investment, only to get better. So I don't think there's any rush whatsoever to monetize that. It's a good investment at the right time, but it does present a strong balance sheet for us, and it's there if it's needed. But there's no plans to divest of that.
Well, speak to the long-term strategy for the company, Scott. Now, we know that there are other highly successful royalty companies over in the precious and base metals space, which you've mentioned some of them. They've been reluctant to even look at uranium. Do you see that this is going to change? And what is the endgame strategy for URC as we continue along in this uranium market?
Yeah, I mean, we recognize we have a first mover advantage. It's amazing that it hasn't happened sooner. So, I mean, we can't assume that we'll be without competition forever. But I do think that, the more diversified or the base and precious metals royalty companies, they look at uranium and they look at it, in regards to what they can do in say gold or copper, zinc, or other commodities. We get uranium, we get the challenges, but we also get the opportunities that are presented by uranium investments. We understand that risk, and what's more important is, people that invest in URC understand and want that risk return exposure. And so, again, it doesn't mean that we take reckless risk in investing in projects in the uranium space, but, we're perhaps better suited to take on that risk than, say, a gold royalty company. So we do have an advantage in that regard, but we have to recognize that this is going to be a very successful model, and we do have that first mover advantage today. It may not be there forever, but we've got to just hit the ground running in 2020. Longer term, we see again, there's no reason why this can't be a $1 billion company. How quickly really depends on how well we execute and we really emulate some of these successful models in other commodities. So it's very exciting. I think the timing of the launch couldn't have been better. Where we are in the uranium cycle couldn't be better. I mean, coming off of a 9-year bear market with strong, robust demand for uranium and nuclear energy, and the need for new mines really sets up. I mean, for ISR developers, okay, they may only have limited, smaller capital requirements to get them into production. Well, we're ideally suited to address those. For bigger projects, I mean, say projects like you have in the Athabasca Basin or elsewhere that are big billion-dollar lifts, perhaps, they're going to need to access all forms of financing, debt, equity, royalties, and streams to successfully bring those projects forward. So, we're ideally situated in either of those cases to be a capital provider.
Why should potential investors who are listening consider Uranium Royalty Corp today as one of their uranium exposure vehicles, Scott? What would you say to them?
I think it does present, and we've seen the popularity of this model in base and precious metals because it gives you that pure play exposure to a commodity, but does so in a diversified manner. The biggest bang for your buck's obviously going to be investing in individual uranium equity, and if they execute on their plans and the market cooperates, you're going to see the biggest returns. The biggest risk-return ratios are going to come from those pure equity investments. But there's risk in that. I mean, I hate to pick on anyone, but I look at the Salamanca mine in Spain. I mean, that should have been a no-brainer. I mean, you have a country with 50% youth unemployment and company coming in to provide high-paying, sustainable jobs in a rural part of Spain, and it doesn't get permitted to go forward, or at least not yet anyway. That's a shock, and I think it shows you how difficult it is to bring on a mine anywhere in the world today. So I diversified. We realize we're going to have a big portfolio of projects and mines in our portfolio going forward. Some are going to exceed expectations, some are going to disappoint, but on net, we hope that we've done our homework, that we're providing returns that we think we'll get. But that diversified pure play exposure is great. It provides something a little bit different than, say, the pure commodity investment in, say, a yellowcake or a UPC, which are, I think every uranium investor needs to have those kind of investments in there, but that's going to have the least risk return pop, but probably the least downside risk. Equities, pure equities being the highest risk return ratio, and then royalty should be somewhere in between. But having said that, I look at uranium royalty companies in gold and copper. They're actually outperforming the pure equities in gold and copper industries. So it's a model that really, I think is a beautiful model, and you can see it's been very successful in other commodities. It's just very exciting to be able to take that to uranium and be the first mover in the space.
Scott, what is the best way for the audience to reach out to you and to the company?
Our website, uraniumroyalty.com, is a good source of information. If you want to do real granular research into the portfolio, the prospectus from the IPO is still obviously very current from December of last year. In there, you can really do the homework on the various projects and see how the capital structures evolved, over the last 3 years. I'm also available, Melbye at uraniumroyalty.com. I really welcome individual investors to reach out to me. Happy to answer any questions. There's nothing I love talking more about than the uranium markets, and especially right now with pretty exciting fundamentals at play. I think our long wait and the patience that's really been required for the uranium investor is going to be rewarded in 2020. And I think URC is a good way to be positioned to benefit from the coming bull market in uranium.
All right, sir. Well, thanks for coming on, and we look forward to chatting again soon.
All right. Thank you very much, Andrew.